Well, I imagine you're about as anxious as I am to get along with the study session on alternative investments, and in particular, the main reading for that study session, Introduction to Alternative Investments. When we talk about alternative, and I think one way to kind of categorize all of these is to think of the fact of stocks and bonds being traditional investments. And so sometimes it's the asset that's non-traditional, but other times it's just the structure of the investment vehicle that's non-traditional. So if you think of stocks and bonds, buying and selling those, traditional, these are the alternative investments. So we'll cover a number of them, learn some of the terminology of it, some of the risks, and some of the key things you'd know to understand investing in these assets. So here is our slide, kind of talking about what I was just talking about, different types of assets held. They tend to have higher fees. I mean, some of the ones we discussed don't, but many of them have higher fees because they're more hands-on management, and they're often structured with an incentive fee to management so that they participate in the gains on the fund. They're typically less liquid than traditional investments, and in many cases less regulated and less transparent. And the tax treatments can be different as well. So the categories that we'll be talking about here, we've got hedge funds, private equity, various types of real estate investment vehicles, commodities, and various ways we get exposure to commodities and why we might want that. There is a category of investment in infrastructure projects, and so we'll talk about defining and some examples of those and briefly some of the characteristics of investing in infrastructure assets. And then we've got a big category called others, so collectibles, your wine cellar, your Picassos on the wall, any patents, things like this, that we'll put that in the final category of alternative investments. Well, we should take a look at the benefits of alternative investments, or the potential benefits of alternative investments. One is, to the extent that they have low correlations with returns on traditional investments, they're going to offer portfolio diversification benefits, risk reduction benefits. And in some cases, there's been evidence that the average returns are higher than traditional investments. Now, the returns measures for these, we believe, are biased upward, and the risk measures are biased downward. And that's because of some bias in the data sets that they're using. There's often survivorship bias in this. We're looking at, say, for example, hedge funds that have been around for a number of years, so we've got some data to work with. Well, hedge fund average life is fairly low. I've heard quotes around 18 months. And so those that have disappeared because they took more risk and it didn't work out too well, or the decision making, the strategy was just, at least for that time period, flawed or not working, they've gone away. So by looking at just the surviving firms, there's a real bias in terms of higher returns and less risk. And another kind of form of this is backfill bias. When a hedge fund gets large enough to be included in a hedge fund index, then it's been around for a while. Well, it's been around for a while because things have been going relatively well, and they've managed risk well, and they've had reasonably good returns. So then when they put it into the index, they take the historical record of that hedge fund and put that into the historical record of the index, and that's where we end up with backfill bias. So, what's going on with these hedge funds? Well, they're investment companies, but they're structured as limited partnerships where they're the general partner, and so all the investors are limited partners. They use leverage to a good extent. They invest in derivatives. They short sell, all sorts of strategies. Really no limitations on what strategies they're going to employ except what they've agreed with their investors to do or not do. They're limited to qualified investors. They're not very liquid investments, and so there are qualifications on who they can sell to. Some of them have a lockup period, and a lockup period is just the minimum amount of time before an investor can withdraw funds. So you may come in and invest if the lockup period is 2 years. well, you can't even think about taking any of that money out of the fund for 2 years. And then we also have a notice period with some hedge funds, and that's days within which a fund must fulfill a redemption request. So if they have a 60-day notice period, you say, okay, I'd like to take this funds out of your fund that I have invested, and they can give it to you then, but they have up until 60 days to honor your redemption request. What kind of strategies do we expect to find in these hedge funds? Well, as I say, it's quite broad, but we do have some that are defined, and you should be familiar with a few of those. Merger arbitrage strategy, and we're under a major heading of event-driven strategies here, so we're talking about some company event. Merger arbitrage, buy shares of the firm being acquired and short shares of the acquirer. I'm not going to go into why that may or may not be a great strategy or has not been a great strategy. We're just defining things here. So if there's a merger going on, then we're taking a position in that merger and trying to benefit from that event, make some money on that event. Distressed investing or restructurings, buying restructurings. If the restructuring will increase value, they can invest in that, but that's often kind of getting over close to traditional investments, just with, I guess, a little bit different focus in terms of strategy. Activist shareholder, been hearing more about that the last few years, that's for sure. Hedge funds taking large positions to gain board seats, influence company decisions, and hopefully unlock value, I think is what they like to say. In special situations, spin-offs of a division, asset sales, large security issuance or repurchase, all of those are special situations in which the hedge fund managers may find opportunities for profits. Our next category here is relative value strategies, where we're not betting necessarily on one thing, but how two investments will perform relative to each other or to securities. In convertible arbitrage, convertible bonds versus the underlying common stock. If they have a better pricing model on what the value of that conversion option is based on the value of the common stock, then they can buy low and sell high across that as an arbitrage trade. Asset-backed securities, mortgage-backed securities, the strategy, again, just a type of security there, or general fixed income. A hedge fund can specialize in buying and selling volatility, trade options based on implied versus expected volatility. So if you think things are going to be more volatile than is already priced into these derivatives, you buy the derivatives, and vice versa. If you think volatility is currently being overestimated, future volatility is currently being overestimated by the market. And a multi-strategy, well, that's easy enough. That's across all different asset classes or several different asset classes. Okay, macro strategies. When we say macro, we're talking about economics. So we're talking about global economic trends that we're looking at, and then either trading securities, currencies, commodities, based on those trends. So those are macro strategies. That's a global strategy, and think macroeconomics when you see that term. Equity hedge fund strategy. Well, by going long and short, you can certainly hedge your market risk in the equities investing. And market neutral would be if you had equal values in long and short positions. So of course the idea there is that your longs do better than your shorts. Even if the whole market goes down or the whole market goes up, if your longs do better than your shorts, you're going to make the difference on that and have some investment returns that are hopefully very uncorrelated with market movements. The fundamental growth strategy, just identifying high growth companies and hopefully not paying for even higher growth. More on the equity hedge fund strategies, fundamental value, identify undervalued companies, quantitative directional. Well, in this case, may have a net long or net short exposure. You'll have other funds, we talked about market neutral, that try and balance the short and long exposure. This other class, short bias, yes, they're long some, they're short some, but they usually have a net short exposure to the market overall. And lastly on this slide, we've got a fund of funds. And that's a fund with a manager that invests in other hedge funds. And you're getting supposedly expertise there in the selection of these, and by investing in multiple hedge funds, you're getting strategy diversification. So you saw all these various strategies they may employ. Well, at any point in time, one of those strategies may be working great or may work very poorly. And so if you have a portfolio of different strategies, you're getting diversification that way. One will be doing better when one does poorly, and that'll smooth out your ride, smooth out your returns over time. With a fund of funds, you do have an additional management fee and incentive fee on top of the hedge fund management fees, and we'll get into more of the details of that in just a bit. So, valuation issues. Should use bid prices for long positions and ask prices for short positions. The sense of that is you're using the price at which you would have to close out your position. So if you have to sell a long position, you're selling at the bid. If you've got a short position and need to buy in shares to close out that position, then you'd use the ask price. So that's why they would value it that way. Now, a lot of times they'll have illiquid, non-traded securities, and we need to estimate the value of these with pricing models. And that brings up a lot of issues. Pricing models can be wrong, they can be biased, and very often they smooth returns relative to what we see in market prices, and so look relatively less risky. With illiquid securities, you'd have to reduce the market price to account for this illiquidity if you had to liquidate that position. And it should be based on the position held. The larger the position you're trying to unload at any point in time, the larger the haircut, the larger the discount to get that liquidity will be. There's something called trading net asset value. So hedge funds in their accounting, they need to do net asset value according with all the securities rules and everything like that, but they'll also report a trading NAV in which they adjust these positions for their illiquidity. So it's an example of more transparency, more information being available to investors. Okay, leaving hedge funds behind, let's talk about private equities. You own a corporation that's public in which their shares are traded, but there's an awful lot of corporations that are private. And public companies can be taken private, and private companies can be sold to the public through an IPO. So that's where these private equity investors come in. They invest in private companies or buy a public company and take it private. Well, what are some of their strategies? Well, you've probably heard the term leveraged buyout. Leveraged buyouts where you borrow a whole bunch of money and buy the shares of the company. So there's the leverage. Leveraged buyout, with the idea being you're going to run the company very well, generate buckets of cash, pay the debt down to a reasonable level, and then often sell it back as a public security when it's a much better looking investment. And venture capital, those two will be our main focus of the material for the exam. Leveraged buyouts and the various types of venture capital investments, which we'll get to. But there's also developmental capital, minority equity, private investment in public equity or PIPEs, and distressed investing, where you're looking at companies that are either just in financial distress or heading into bankruptcy, the bankruptcy committee, are their bonds cheap, are their shares going to have value later? That's, again, just an area of real hands-on investing requiring a lot of work, and it's been around with us for a long time. Leveraged buyouts. Okay, bank debt or high-yield bonds are the two main sources of leverage of the funds to do these leveraged buyouts. When we talk about mezzanine financing, we're talking about subordinated debt that includes some warrants or conversions to equity. Now, we'll call it a management buyout if the current managers are involved in this and they're going to stay in place, remain with the company. With a management buy-in, we're going to buy the company, throw the supposedly incompetent managers out and replace them with good ones so we can what? Pay down that debt and make this look like a good, stable, valuable company. Now, venture capital. I mentioned we'd have some types for you. So here we've got some stages. We've got three listed here: formative stage, later stage, and mezzanine stage. Now, let's start with that mezzanine stage. Mezzanine always means in between something, or almost always means in between something when we use it in finance. And here it means between being a venture capital private company and being a public company. So that's a shorter term investment to dress this company up, take care of any personal loans, things like that, get it all cleaned up financially to prepare for the IPO, and then the mezzanine finance be paid back with the proceeds of the initial public offering. So at the very beginning we have the formative stage, and the very first one is called angel investing, and that's at the point of the business plan, the idea, estimating the market potential, things like this. After that comes another very early stage, the seed stage, in which we're dealing with product development, market research. And early stage, that's still in the formative stage, so through the formative stage we've gotten from an idea to begin production and sales. So almost a real company. Then 2, later stage, company expansion, expanding their production, expanding their geographical reach, all sorts. And then the third one, the mezzanine stage, getting ready for the initial public offering. So how are these private equity funds structured, and what are their fees like? Well, they are also typically structured as limited partnerships. The investors provide what we call committed capital. So I commit to a $10 million investment in this partnership. And then over time, as they buy firms and make investments, managers draw down this committed capital to invest in the companies. Now, the reason this is important is that management fees are typically somewhere between 1% and 3% of committed capital, not just the drawdown capital that's actually invested in portfolio companies. And that's fine. It takes money to go look at companies. They've got their expenses, looking at companies, trying to find them, evaluating them, doing the purchases, everything like that. But anyway, that's just the point, is that it's on committed capital. And then there are incentive fees on top of that management fee. And these incentive fees are typically 20% of profits. And there's something called a clawback provision. And you can imagine that they've bought some portfolio companies, and now they've sold 2 of them. And those 2 did really, really well. And they kept 20% of the profits on the sales. But then we have some that didn't do so well, or 1 or 2 that just went bankrupt. Okay? So you could get to a situation where the fees paid to the general partner have exceeded 20% of what's really happened in all the portfolio companies in which they've disposed of them one way or another. And a clawback provision says, well, the managers have to return that, and they can't exceed 20% of profits on the whole fund, the whole bundle of investments. So how do you get out of a private equity? Well, one way would be to sell it to a competitor, or sell it to another private equity investor. The preferred way is to have an IPO and sell a portfolio company shares to the public. That's usually how you raise a lot of money, but you could sell it to a competitor. Okay? They might want to grow that way, or another private equity company may think they can do more with it and eventually bring it to an IPO. We can do a recapitalization, just issue portfolio company debt to fund dividend payers to the private equity owners. So if we've got no debt and $100 million in equity, so okay, borrow $50 million, take that $50 million, pay it to the equity holders. Now you've got a company that's $50 million equity and $50 million debt. So that's a recapitalization. And the least favorite way for exit strategy is to write it off, liquidate it, and take a loss. Well, in terms of valuation, some of these techniques that we use are similar to what we see in real estate. The first one being the market comparables approach. We look for similar companies with as many similar characteristics as we can that may be publicly traded and look at the values of those. Of course, the liquidity of a publicly traded company probably gets some premium to a private company, so you'd have to keep that in mind. Discounted cash flow, just get into the financials and try and project the cash flow and the rate of growth of cash flow just out as well and as far as you can. Get some appropriate discount rate to use and take the present value of all those cash flows. Or the asset-based approach, but as we know, that's often more pertinent and more accurate in a liquidation situation. Hopefully most of our companies are worth more than the fair market value of their assets if they were sold today. And private companies may require different discount rates or price multiples than publicly traded companies. And one of the primary reasons for that is, as I mentioned, that the liquidity of public shares makes them quite a bit different investment from a minority investment in a private corporation where you have really no say in anything about it. Okay, what types of real estates and real estate properties are we going to be talking about in alternative investments? Well, residential properties, commercial properties. We can have mortgage, or we know all about mortgage-backed securities. Real estate investment trusts are a way that real estate is held, and some other categories of real estate are farmland and timberland. Nice because they have some income on their own very often. In terms of valuing real estate, we can still talk about comparables. That's how they do the residential real estate. Let's look for similar properties in your area that sold recently, and that's, we'll make certain adjustments for differences in individual properties, but that's basically the approach. The income approach, similar to the cash flow approach we were just talking about, present value of future cash flows from the property, or net operating income, which is the net cash flow from the company, and dividing that by a capitalization rate, but that's really just the other thing turned upside down, right? If you know the value, you multiply it by the interest rate, you get the net operating income, and vice versa. So it's a lot like present value stuff. Cost approach, replacement cost, including land and current costs to rebuild. It's one approach. Don't use it a lot. If there wasn't any income or cash flow right now for some reason and comparables were hard to find, you might try the cost approach to at least get an idea of the value of the real estate. And we can have our income-based items, which is very similar to this direct capitalization, take net operating income and divide by the cap rate. We can use funds from operation, FFO, very popular measure with real estate investment trusts, adjusted funds from operations, so that's going to have some requirement for adjusted for the monies required to keep things going and the upkeep and things like that. And capitalization rates. Well, capitalization rate, we can divide by the interest rate or multiply times 1 over the interest rate and call it a multiplier, but it's really mathematically the same thing. The asset approach to calculating an REIT's net asset value, which, like a mutual fund, market value of total assets minus the total liabilities over the number of shares outstanding. So I guess I didn't say much about the asset-based. I think with some real estate investment trusts, the way to go about it is if they have 15 shopping centers across the U.S., then you'd need to value each of those shopping centers on an ongoing basis. So certainly they're doing that within the fund, but for the average investor, it sounds like a lot of work. Commodities and commodities exposure. Now, most commodities exposure is through derivatives rather than outright ownership of gold or physical oil or wheat or copper or silver. And the return comes from the price change. There's no income expected from commodities. And commodities have acted as a hedge against inflation. And what we might want to say is when we've had high inflation, most all the time, commodities, or a good number of commodities, have also made highs in terms of their prices and returns. So, how will we invest in commodities? Well, we could have a commodity ETF, exchange-traded funds, so very liquid, traded on the exchange, available to investors who are restricted to equity shares. So if that's the only exposure you can get, then it's there. You can also buy shares of commodity producers, by the gold miners or the junior gold miners. Less than perfect correlation with commodity prices. Yes, we've certainly seen that. So that's another way, though, to get exposure to commodity prices. Certainly, if you're investing in an oil company, you've got some correlation with oil prices, and if you're investing in a gold miner, you certainly have some pretty strong correlation with gold prices as they affect earnings. Managed futures funds, you can have an active manager of commodity investments, and how you do is going to depend on how well that management performs in anticipating market moves and opportunities. You can have an individual managed account where your manager just invests for you, and a commodity sector fund. So that would be a mutual fund of companies that have exposure to commodities in one way or another through their earnings. Well, commodities valuation, I think you've seen this in derivatives. Futures price equals spot price times 1 plus the risk-free rate. Okay, let me just run through this with you. Be a good refresher if nothing else. Why is that line there? That line is there because in order to deliver the asset in the future, I've got to buy it and store it. And so that, at the very least, I have the opportunity cost of the money to buy it, so that's the 1 plus the risk-free rate times the spot price that I pay right now to buy it. If there are any storage costs, I add those because that's an additional cost of creating this future asset. If that asset pays any cash flows along the way, interest, dividends, or has a convenience yield, that is, there are additional non-monetary benefits of holding the physical asset, then we subtract those. So that's where that equation is coming from. And we're going to say the convenience yield, value of having the physical commodity available for use. So for the purposes of the exam, that's all we need, so we're going to stop right there. Now, if the convenience yield is low, then we find ourselves in a situation of contango, where the futures price is above the spot price. Well, we've got this as a plus. We've got this as a plus. So if this is very, very small, futures price is greater than the spot price is less than the futures price. So that's what we've got here. And by the same token, with a high convenience yield, we could have backwardation, where in fact the futures price is less than the spot price, and that would be because we had a big minus here. So if the value of having the physical commodity available for use is very high, we could have this situation of backwardation. Spot greater than the futures price. There's also a category of investments here under alternative investments of investments in infrastructure, and I think we can define that as long-lived assets that provide essential public services, but looking at the examples is probably even more helpful. Roads, bridges, airports, pipelines, waste treatment plants, communication infrastructure, fiber optic cables, all those underground tunnels, all that sort of stuff. And then social infrastructure, at least we could call it that, such as schools, hospitals, and prisons. Well, the types of investment in infrastructure seem to be quite varied from looking at this slide. Direct investment, well, that would be large size. If you build a tunnel, you build a bridge, you build a electric generation facility, yeah, that's big investment, low liquidity, And then you've got to operate it and maintain it, and the returns typically would come over many, many years. As far as indirect investment, we've got the whole laundry list here, from master limited partnerships, regular firms, mutual funds, private equity funds, unlisted mutual funds, exchange-traded funds. It's all there. So this is a growing area. I think it's getting more attention all the time. And so what are some of the characteristics of this? Well, if we're talking about existing infrastructure investments, which are sometimes called brownfield investments, they have less risk and lower expected returns compared to kind of more optimistic ventures, which we call greenfield investments. This is infrastructure to be built, and so you have that execution, you have the pricing, you have the demand, you have a lot of unknowns there, so it's more risky, and I guess on average you should expect more risk and higher returns in greenfield investments. And there can be regulatory risk inherent to any of these infrastructure investments because you're having to deal with government at some level in doing your construction of the assets. Okay, let's have a little more detail on hedge fund fees here. A common structure is a 2 and 20. The 2% management fee, that's each year on assets. 20% incentive fee, 20% of the gains go to the general partners, the managers, and we'll see some adjustments to these, some additional factors that may come into it. So this is kind of our starting point, is a 2 and 20. This management fee may be calculated on beginning or ending assets. If you're given a question, you need to know that. It should be given in the question. Incentive fee may be net of management fees or independent of management fees. So if it's net of management fees, we're going to take out the management fee, okay, before, well, I should say it the other way around. We'll take what the fund grew to, take out the management fee, and then see if it qualifies for the 20% profit on that part. If they're independent of it, we're going to calculate the 20% incentive fee, and then we're going to take that out, and then we're going to take the management fee out too. Okay? And fund of funds, I mentioned they had another layer of costs in addition to the cost of the hedge funds that they buy. They typically charge 1 in 10 on top of everything else. So a 1% management fee for their selection of the funds and handling your funds and everything like that, and 10% of the profits from the investment in the funds. Okay? So that's a 1 in 10 overlay on top of a bunch of hedge funds, which may have a 220 structure in place. Another couple of terms that you may run into in hedge funds and hedge fund fee structures, there are hurdle rates sometimes. And a hurdle rate says, well, you've got to earn at least this much profit before your incentive fees kick in. So you can't just invest in a risk-free assets and earn 4% and collect 20% of that. That's not the deal. So they could have a hurdle rate specified in the agreement, in the partnership agreement. And when we talk about a hard hurdle rate, the incentive fees only on gains above the hurdle rate. So if we got a hard hurdle rate of 7%, the incentive fee is figured on gains above 7%. Now a soft hurdle rate is more like a trigger. You get incentive fees on all the gains, but it only kicks in if the return exceeds the hurdle rate. So that's why I say a trigger. Returns exceed the hurdle rate, they get their 20% incentive fee on all the gains. Another term along these same lines with hedge fund fees is a high water mark. A high water mark just says, we're not going to pay you twice for making the same returns. So the fund's $10 million, it grows to $12 million, you pay them, they're 20%. Now things don't go so well, the value goes back to 10 million. Now as it goes back from 10 back up to 12, if there's a high water mark, they don't start getting incentive fees again until it gets back up to 12. So that's what I meant about you're not going to pay them incentive fees on getting from 10 to 12 2 times in a row. We don't want to make a career out of that. So a high water mark says these incentive fees are only on gains that get assets above their highest previous value. Let's look through in a little example here just to make you comfortable with calculations on these hedge fund fees. Our setup here is that assets under management before fees are 110 million at initiation, 102.2 at the end of year 1, and 118 at the end of year 2. The fee structure is 2 and 20 based on beginning assets for that management fee, incentive fees net of management fees, a soft hurdle rate of 5%, and a high water mark. Well, we've complicated this as much as we possibly could for you, so let's take a look at each of these and see how it works out. Year 1, management fee. Well, we said that was on beginning assets, right, which were 110 million. 2% of that's 2.2 million. That's the management fee for year 1. What is the return net of the management fee? Well, we take out the management fee, and we see that our return is that we got from 110 million down to 100 million, I guess, net of fees, and that's a 9.1% decline in value. No incentive fee. The return was certainly lower than the hurdle rate. Total fees, 2.2 million. We knew that. Okay, beginning value now after the management fees out, we're down to 100 million. The management fee charged on beginning of year assets is 2 million, 2% of that 100 million. The return net of the management fee over the year, well, they grew it to 118 million, and we're going to take the management fee out of that and show a return of 16% for the year. Well, that's going to exceed our hurdle rate. So our incentive fee there, 1.2 million. But we had to take account of that high water mark. So we're just talking about the highest previous value that it had and how much above that. So that's why we're using that 110 there. So it was, as I recollect, it was a soft hurdle rate, so we're going to get an incentive fee on all the gains because we exceeded that, but we aren't going to get money in an incentive fee for the return of assets from 100 million back to 110, only on the movement from 110 to 116 net of fees, which is where we get the 1.2 million here. Net return to investors, 14.8%. So hopefully we brought a little of each of those terms into it to give you a better feel and help you remember some of that. Well, what about risk management in these alternative investments? Well, at least in a good number of them, standard deviation is not the most appropriate risk measures. We may have returns distributions that are leptokurtic. They've got fat tails. We may have them with negative skewness. So negative skewness meaning, well, there's a number of events with relatively low probability but are extremely negative. So a skewed distribution. And so those are two reasons that standard deviation is not the most appropriate risk measure. And we've talked about returns being smoothed because they're model or appraisal asset valuations. With real estate, you get appraisal values and they are smooth. They're not as volatile as market prices. And certainly neither are model ones, but there you have model risk or model bias as well. So the suggestion here is that you use some sort of downside risk measure. Either value at risk make statements, measures are along the lines of, we will not lose more than $5 million over a one-year period with a probability greater than 5%. Or let me put it another way, there's a 5% or less probability that we will have a drawdown of $10 million over a 12-month period. That's a measure of downside risk, and we're talking in terms of probabilities, but how bad could it be? Trying to address that. And the Sortino ratio, which uses downside events rather than standard deviation, uses both up and down, surprises and variations. Sortino ratio is based on downside risk, so it's a similar measure but calculated on downside risk. Okay, we may also have risk from the use of derivatives. We may have counterparty risk, liquidity risk with custom over-the-counter derivatives, operational risk, financial risk. All of that can arise from derivatives. The performance clearly will depend over time on the manager's skill. There can be a real lack of transparency when we're using these valuation models and things like that, and illiquidity. Any securities you have that don't trade very often, you just don't feel as good about the valuation information that you're getting. Correlations with investment returns vary over time and may increase during periods of crisis. So just when you want the diversification benefits of having a low correlation with the returns on traditional investment, everything goes down at the same time. Correlations can spike and defeat one of your purposes or potential benefits going in. Well, that wraps up alternative investments. I hope you've had a good time, and I hope you do just terrific on your CFA exam.